Hi folks, welcome to another episode of Investment Income for Life. Today, I am going to touch on a very sensitive topic, that is, the use of margin financing as an investment tool to boost passive income and to reach early retirement way before the official retirement age of 63 in Singapore. The official retirement age is set to rise to age 64 with effect from the 1st of July 2026 as the life expectancy of human beings is set to reach 80-90 years old with advancement in medical science. I have been mocked numerous times before on public forum during COVID period which saw a huge plunge in valuation of my investment portfolios. Saying that, I have never been forced to sell off my marginable holdings albeit being close to the verge of a margin call during the aforesaid crisis. For this episode, I will be sharing my personal investment journey using the margin strategy. 1. The irony of many retail investors who condemn the use of margin financing for equity investing but okay with 75% leverage on two private property. I find it somewhat ironic that there are people who kept talking sheep on folks who used margin financing for stock investment but are okay with the property investment strategy of buying two private properties and leveraging up to 75% borrowings. Yes, there are couples who are heavily leveraged till their underpants invested in this buy one to live in and buy another one for investment approach. Putting all your eggs into one basket in property market and believing that Singapore property will always appreciate in a foolproof way to make money is dangerous. Look at what is happening to Hong Kong properties and you will know that nothing goes up forever. 2. The use of margin is a double-edged sword. Using a margin account to accelerate retirement is extremely tempting because it allows one to leverage to invest more than what one currently has. This can amplify gains, potentially growing your portfolio faster and enabling earlier retirement. Saying that, margin investing is a double-edged sword. It also amplifies losses and introduces significant risks. 3. Not much of a choice for many common folks like me to escape the rat race. Of course, I am well aware of the potential downside risks of using margin. Nonetheless, this may be the only conceivable route out of the rat race. The management of the downside risk with finesse while getting a boost in investment return is essential to the successful execution of the margin strategy. For example, if one took up a margin loan of 250,000 Singapore dollars at 4.2% interest rates, if the dividend yield of the marginable securities is 6.5%, this will be an additional 2.3% per annum of net income after paying off financing cost. This is an additional income booster of 6,000 Singapore dollars per annum. Assuming no drawdown of this income and that it is reinvested in Endowus bond fund or index funds at 5.25% per annum, one will gain additional net income of 252,150 Singapore dollars over 25 years. This will also mean a dividend yield of 8.8% per annum excluding potential capital appreciation. I will go on more in depth on the technical mechanics of using margin in the next episode. The above points summarize my train of thoughts on why I decided to embark on this, riskier, investment path. Okay folks, that's all for today. Have a great week ahead and may you be well and happy always.